Out of all the high yielding ETFs that are out there, especially the covered call ETF space, YieldMax is one of the biggest names out there, and they have just came out with their new 0 days to expiry covered call strategy ETF on the S&P 500. Ticker symbol is SDTY, and it is a very new ETF. It seems like YieldMax is coming out with new ETFs every single week. So they have a huge fund portfolio under their belt. And it's kind of a little bit scary how they have so many ETFs because they're all actively managed. Instead of coming out with all these new ETFs, they should honestly just focus on the existing ETFs and help build those performance a little bit better. So this ETF right here is a direct competitor to Roundhill's S&P 500 0 days to expiry covered call strategy ETF XDTE, one of my favorite and largest holdings in my portfolio, just because of how stable the NAV is. As we can see at inception, it had about $52 a share. At the lowest point was around here, $49 per share, down 6%. And at its high point, it's around $53, $54 per share. So currently sitting around $50 per share, that's really where it's stable at. And honestly, that is why a lot of people are flocking towards XDTE rather than the YieldMax ETFs, especially TSLY, Coney, you have YieldMax, and those all are experiencing very severe NAV erosion. So if we take a look at SDTY, we don't have a distribution rate yet as it just came out last week. So we're really not sure how it's going to perform. But if it's utilizing the same strategy, the 0 days to expiry covered call strategy as Roundhill's ETF, we can probably assume some very similar returns. But honestly, if we take a look at the expense ratio, it has a 1.01 expense ratio. YieldMax is known for its very high expense ratios. They like to pay out their fund managers. But if we take a look at XDTE's covered call strategy ETF, pretty nice distribution rate of 26, very healthy. It's not seeing anything crazy like 100% distribution rate. So we have a very stable NAV, and we have a very safe distribution rate, in my opinion, for this type of ETF. Now, of course, 26% is much higher than a lot of high yielding dividend stocks and ETFs out there. But this is utilizing a covered call strategy, it's trading options. So it's a little bit different than holding say a dividend stock like Coca-Cola. So if we take a look at the fund details, it does have a high expense ratio as well, but it is a little bit lower, 0.95%. And that's really why we are kind of flocking towards the Roundhill ETFs. Honestly, I think they have some of the best ETFs out there. XDTE, there's also RDTE, which is the NASDAQ, the same covered call strategy. And these are all very great funds. The best thing is they pay out weekly distributions. A lot of people, it's about a mentality to invest. If someone has a growth stock such as QQQ, it does have a dividend yield, but it's very, very low. And a lot of people really need to stay focused in investing and be patient. And this kind of helps people get into the mindset of investing by receiving those weekly payouts, those weekly distributions. It really keeps you on track. It keeps you invested in the market. And overall, time in the market is how you grow your portfolio. Now, of course, there are a lot of different high yielding dividend ETFs. There's also growth ETFs that you can invest in. So not every ETF is for you. There's different strategies that you can utilize based on your risk tolerance as well as your portfolio size. In my opinion, if you have a very small portfolio size and you are very young and you have time on your hands, you should probably invest in growth ETFs because you can withstand that high volatility. But if someone who has a lot of capital, a lot of money, a little bit older, or they just want to have a good mentality in investing, dividend ETFs, especially weekly paying ones, are a great strategy as well.